we've got a very busy week ahead of us, packed with potentially informative statements. On the macro front, the big numbers of the week coming up will be the first estimates for fourth quarter GDP growth from the UK on Thursday the 26th and the US on Friday the 27th. Remember that in Q3, the UK grew 0.6% quarter on quarter and 2.2% year on year, while the annualised growth rate in the US was 3.5%. They're your benchmarks. Do note, however, that we're only going to be getting first estimates this time around and 2 revisions will follow. In addition, GDP is a backward-looking data point, whereas financial markets are forward-looking discounting mechanisms. So stocks and bonds are already looking to 2018 and beyond, so don't get too carried away with the GDP numbers, as the direct implications for stocks are likely to be, well, pretty limited. Bottom up, we've got 10 FTSE 100 firms due to offer results or trading statements, and they're going to include BHP Billiton and EasyJet on the 24th, Diageo, Sky and Whitbread on the 26th, and BT on the 27th. But for me, the company really capable of causing a fuss is Unilever when it reports fourth quarter and full year results on Thursday the 26th. Now, the Anglo-Dutch food to personal care and hygiene giant owns Knorr, Ben & Jerry's, Marmite, Persil, Domestos and lots more brands beside. And of course, don't forget Marmite was in the news in the fourth quarter over Unilever's attempts to stuff a price increase through Tesco, something which the supermarket giant resisted. Pricing power is really the secret to these brands though, and without it, Unilever, well, maybe has a bit of a problem, so these results should be very informative indeed. And beyond that, there are 3 things to watch. First, Unilever's underlying sales growth. The company's a target of 3 to 5% a year. As we can see here, Q3 came in at the low end of that range, and for Q4, Unilever's own website suggests the analyst consensus forecast is for just 2.8%, comprising 0.2% volume growth and 2.6% in price increases. Second, look for reported profits. At the operating level, analysts are looking for around €8 billion for the year just ended, with an operating margin of 15.2% compared to 14.8% last year, helped by a group-wide drive to cut costs by €1 billion up to 2018. Third, profits guidance for 2017. Again, markets are forward-looking. Look, and analysts are going for an 80% increase in profits to €8.6 billion and a hike in the operating margin to 15.6%. Now, lots of things could drive that. Cost increases, price increases, currency movements, customer resistance to prices. So let's see what boss Paul Polman has to say on the margin side. And keep a particular eye out for any comment on India, which could have been a big drag on Q4, owing to Prime Minister Modi's demonetisation plan. It caused chaos and could well have affected Unilever's numbers. The final question now facing investors is what to do with a stock that's attracting the tag of expensive defensive, since it trades on nearly 21 times forward earnings with a yield of 3.1%, the former a premium, the latter a discount to the FTSE All-Share. And as we can see, Unilever has come off of late. Now, this is because the market's moved away from quality growth stocks to more cyclical turnaround plays, away from Unilever towards miners, oils and banks, although Unilever has begun to rally a little bit of late, helped by weakness in the pound, as that increases the value of the firm's overseas earnings. The issue, therefore, is what price are you prepared to pay for the relative safety of Unilever's earnings, cash flow and dividends, assuming, of course, they prove to be safe, and that's something only you can decide for yourself. Thank you for watching, and I look forward to seeing you next time.